Hello, in this video we'll be talking about the financial statement analysis. So in the past few videos we have been going over the different types of financial statement. Now we'll be able to understand how to analyze the data and get some insights from that. So I'll just start out by writing financial statement analysis. So that means you're trying to analyze the financial statement. So just remember the financial statement, the three main financial statements that we've gone through, and I'll make sure I'll leave a link at the end of the video. Number one, the main reason for doing this financial statement analysis is to compare the performance among various companies. Now, if you're an investor, you would probably want to compare the performance between various companies, but there is a certain thing, small minute thing that you have to notice, that you can only compare among companies that are in the same industry. And number two, we have comparing with our own self, our own past performances. So we compare with our own past performance, we choose a company and we see its historic performance, and we try to see whether it has some steady gains so that it'll be easier to predict future profits or losses. So we'll be talking about a lot of ratios in the next few videos that are created from the financial statements to get some insights about the company. So in this video we'll be covering profitability ratios, and we have three profitability ratios. So let us see. So profitability ratios helps us to determine how profitable a company is. So gross margin is the first one. So gross margin is equal to gross profit divided by total sales. Gross profit divided by total sales. Okay, so if you remember, gross profit is actually total sales minus total cost of sales. So let's say, for example, total sales is about $40 and cost is 10. In another case we have 30. So when we subtract that in the first scenario, what happens is that we get about 30. And so let's try to use a ratio here. So it would be 30 divided by total sales, which is 40, which would give us in percentage terms about 75%. And the bottom scenario would give us 25%. So the 25% is very low profitability. It shows very low profitability of the company, and 75% shows very high profitability of the company. And the same concept can be applied here to the operating margins, right? So the operating margin is equal to the operating income divided by total sales. So just like in the previous case, right, the higher the ratio, the more profitable the firm is, because the cost has to be less in order for the ratio has to be high. In the first case, we have to make sure that the cost of sales is very less in order that the ratio overall, the percentage is high. The same thing over here, operating income is equal to gross profit minus operating expenses. If the operating expenses are very low, the ratio will be higher. That means it is more profitable firm. And finally, we have the third main ratio, which is the net profit margin. The net profit margin is very important. So it is net income divided by total sales. Now if you see a pattern here, all of the three ratios we divide by total sales, right? That is not by mistake. So let us see. So do you remember that we call the net income as the bottom line in the income statement, because it is the bottom line in the income statement, in most income statements. And so this tells us that how much dollar the shareholders can keep per $1 of sales. So for every $1 of sales, what percentage or how much percent of that $1 can they take? If you say 10%, that means 10 cents of the dollar of sales, they can take it as net income. Investors see this as an important ratio. Yes, right. A lot of investors see this as a very important ratio. Okay, so these are the three main types of firms. If you really like the video, please feel free to subscribe for more awesome content. Thank you.